Welcome to part 2 of So You Love Finance and Analyzing Data. Last week we discussed market risk, and watching back the video I've realized I never actually defined market risk. So market risk are the risks, unexpected and undesired, that the market might make moves that negatively impact you or your client's portfolio. For example, if you have an equity portfolio or bonds and you constructed the portfolio pretty well, but something happens and the market as a whole makes a move and that impacts your overall portfolio. All right, now with that out of the way, on with the show. So credit risk. Credit risk is huge, and it covers much more than just banking and asset management. In general, if you stopped anyone on the street and asked them to define credit risk, they would say it's credit worthiness. And that's really what the risk we're concerned about. Is this entity going to be good on its obligations? For banking and asset management, that's more specifically the risk of your portfolio losing money due to credit worthiness, the most popular example being counterparty credit risk. It's one of the most analytical roles in banking after market risk. In terms of degrees, you definitely need an undergraduate degree. Something more quantitative or finance related is really helpful. And I've seen that at the more senior levels, having a master's degree or additional certification is pretty common. For non-banking, you're really not focused on portfolios. It's really about credit worthiness of new applicants, or even looking at your existing customers and doing ongoing checks of financial performance or similar analysis. The pay in terms of banking and hedge fund, because that's all I know really, is great. It's along the lines of market risk. For risk roles, it's really great. Even in the non-banking sector, it tends to pay well compared to its middle office counterparts, but it's not a money-making role. It never will be, so you'll never make the most money with credit risk. Still really good. The hours are similar to market risk in both banking and asset management, and mobility is really, really good. And that's pretty funny because credit is like a pretty specific niche, right? Whereas market risk, for example, like the markets are huge. But credit's great for mobility, specifically because from credit risk, since you're doing so much credit analysis, you can move into a credit research or even a credit trading role. Any role, pretty much, that starts with the word credit, you're now eligible for. And I've seen these moves all over the place. Liquidity risk. Now, liquidity risk refers to how a bank's inability to meet its obligations, whether real or perceived, threaten its financial existence. Now, it became really popular after 2008. In fact, when I was working at Morgan Stanley, 2013, there wasn't even a liquidity risk department. I remember the bank took the head of market risk analytics and made him the chief liquidity officer of the firm, and then built out a liquidity division. They were going around asking market and credit risk analysts, hey, do you want to join my team? I actually got, within the bank, I got interviewed to move into the liquidity team, which is pretty cool. And around the same time, all the banks were doing that. It's a pretty important element for enterprise risk management in banking. A bank's liquidity framework should maintain sufficient liquidity to withstand all kinds of stress events. And that's really what the Fed's concerned about. Obviously, I've never been in liquidity risk. You can tell that from everything I've talked about. But I spoke to a few friends who have moved into liquidity risk, and I got a pretty good idea of the following. So the pay is pretty good. It's not bad. I've noticed that at levels similar to market and credit risk, it tends to pay a little less, but it's pretty similar. So similar lifestyle. The hours are similar to market risk in banking or funds, but they're possibly a little longer because you're not actually tied to trading hours because you're not actually monitoring trades. So it tends to be a little longer, the hours. The mobility is really good, but only for liquidity roles, which are far less, as already discussed, than market or credit risk. I'd like to introduce you now to a table. And over here, we're going to look and compare the three major risk roles that we've discussed. So market, credit, and liquidity. For coverage, market risk, you cover markets. So it's a very broad range of things that you cover. Credit risk, you're covering credit worthiness. You're analyzing prospects or counterparties. And liquidity risk, your ability to meet obligations or withstand stressed events. In terms of pay, I would say market risk gets an A+. And this is specifically for the middle office type roles. Credit risk, I would give an A to. Pays really well, pretty much in line with market risk. And liquidity, I'd give an A- to. Mobility, market risk gets an A+, because even in the firm roles, the firm risk roles, which are pretty great, but not related to sales and trading, still you have great opportunities to move within the bank or to hedge funds. But when you're on the trading desk, naturally you can move into the trading roles if you're a good networker. So really excellent mobility opportunities. Credit risk gets an A for mobility because you can move into anything credit. Liquidity risk, I'd give a B- to, because you're really constrained by liquidity. Obviously within the liquidity and liquidity risk world, you're pretty valuable because there aren't too many people. That's why it doesn't get a D. Since there are so few liquidity analysts, you will get poached and you will have good opportunities to move, possibly for raises, but you really can't get out of that liquidity umbrella. The hours across the board are A. I say they're really good. Liquidity might be slightly worse, but still pretty good. Some honorable mentions: operation risk and compliance risk. Now, this might be a little unprofessional of me to say, but I'm just going to say it because I know a lot of people working in both. Everyone that I know who works in operational or compliance risk, they don't love their job. I'm not hating on the job. I'm not saying it's a terrible job. But the point is, they all got into it excited to work in banking or in finance. And the truth is, there's not a lot of finance. In compliance, you might be looking at stocks, but you're looking at stocks only to bust people for doing illegal trades. In operation risk, you might be looking at traders and interacting with them, but that's really just to flag them for things. So you really don't get very involved with the finance, which takes that element of fun out of it. The pay is not great compared to the other risk roles. Mobility is not great. You're very constrained to those roles. And the hours actually tend to be worse. That being said, these roles, operation risk and compliance risk, are very good gateways into the other risk roles that we've described. So if ultimately your goal is to be a trader and you cannot get into Goldman Sachs, for example, but you got an offer for an interview for a compliance or operational risk role, I say take it if you're confident in your networking abilities, because ultimately you will be able to make a move if you're good at networking. Now, too much experience is not good. If you do 5 or 6 years in operational or compliance risk at a bank and then hope to move into something else, it's not going to work. You'll kind of get pigeonholed into it. That will happen. But getting a year or two experience, I've seen do amazing things. And quite honestly, a lot of my clients come to me with a year or two experience in these roles, and I help them make moves into other areas. I hope you enjoyed this video, and I'll see you next week.